Hey everyone, welcome to episode, I don't know, we've already done episode 100, but so I don't know what to call it, but this is number one of what will be 1,000 posts over the next between now and December 31st. So here's my question. I'm going to duck for a second out of the way. Why tangible assets? Why tangible assets? So a tangible asset, a physical asset is like real estate. It could be gold, silver, platinum, palladium, osmium, strategic metals, critical minerals. You could even call it oil and gas, even though it's in the ground, and you're most of the time you're not the one who's you're not the oil company, but you can buy the mineral rights, or you can invest in wells and actually have assets in the ground. So those are things you own. For example, you guys know I have a little hot sauce business. Well, the hot sauces I own are my physical assets, my tangible assets. I can buy a bottle for a certain price, and then I can sell it for a higher price, giving my ROI. Obviously, that's obvious. But what is interesting about physical and tangible assets is it's hard to steal them. People can't just take them from you. Generally, it's hard to. I mean, there is home title theft. You guys should look up home title lock, and if they have some good programs right now. But what I want to do is I want to own things. I want to own property. I want to own metals, minerals, rights. I want to own those things. Do I have stocks? Yeah, I have a few stocks. Stocks are I mean, it's good. I mean, if you get in early, or you get in a blue chip like a Tesla or a Microsoft or something like that, you're gonna do amazing if you can get enough of it. But people don't usually, you're a small time player. If you own 100 shares of something or less than that, you just own stock. Eventually, you can liquidate your whole portfolio. Maybe you own about 50 stocks and you own about 10,000 shares. I mean, people own stocks. But stocks is also where people can get defrauded. I mean, you can get defrauded in real estate. You can get it in physical assets as well. But let's talk about let's talk about Bernie Madoff. Let's talk about the Enron, WorldCom, Theranos. There's a lot of ways out there you guys can. I mean, crypto right now. You got FTX, you got Kraken, you got uh, the Tethers, you've got. I mean, literally, there's like Celsius and Silvergate Bank, and there's a few other ones. A lot of frauds out there right now in crypto space. But what happens a lot of times is, you a lot of these Ponzi schemes and other scams. Just watch American Greed. Watch like 2 episodes, 3 episodes, and you pretty much don't want to watch the rest. But I'm pretty much fascinated by it. I like Fire Fraud, the Fire Festival, things like there was some other cases similar to that. But what happens a lot of times is it's easy to actually perpetuate a Ponzi scheme, because if you look like Bernie Madoff, where he actually had a whole division, a whole group of people on his 17th floor of his building. I think his main company was on the 19th floor. And that was his legitimate that his sons ran, and his brother was the compliance officer, and his niece was general counsel, who all had no clue what was going on 2 floors below them, even though people from that floor, two or three, would be in and out of the main office. So what happened a lot of times is they would produce statements, and they had all kinds of the older printers. There was the dot matrix and the ones that had you had to tear the pieces off. So they had the green ones. They could generate old statements. They would take things like they would put it in the microwave. They'd crumple it up, piece of paper, crumple it up, throw it in the microwave. They would actually then straighten it out. They'd take a manila folder. They would actually spill coffee on a table, set the coffee pot on the coffee, and then put it on the folder to make it look like had coffee spilled on it. So they would make these folders look old. So people come into the office, they would go on with these old folders. Hey, here's your file. It's that thick. It's all fake. So Bernie Madoff would pay like a certain percentage. It wasn't so high that it would become obvious. Obviously, I think he only had 4% of his months were down. So that guy Marco Polos or whatever, I forgot what his first name is, basically discovered that it was a fraud. His company had asked him to reverse engineer because they wanted to produce the same results, and it only took him like an hour or two. And he spent. The guy was maniacal about trying to get the SEC involved. Here's the thing: the SEC is is one of the most underfunded agencies in the government and in the enforcement division. It's really especially true. So they're going to go after a lot of these big ones, but at the time he was the chairman of NASDAQ, and he had so much trust. And a lot of these SEC guys, the lawyers and the investigators, where a lot of them are just out of school, out of college, and they went to business school, or they didn't want to like upset a guy that could be employing them, because most of them were just biding their time at a government job until they could get out of Wall Street, where they make the real money. And obviously, having worked for the SEC, they would probably be in demand by Wall Street firms, to be traders, analysts, and compliance, especially, So they didn't want to upset Madoff when so they kind of went in soft and kind of asked soft questions. So what I'm getting at, obviously how he was able to perpetuate this as well was using a lot of feeder funds, and people would put money in other hedge funds. There's a couple examples in the movies with Richard Dreyfuss and the movie with Robert De Niro playing him, but where he would get feeder funds and they would get a percentage. Well, they would sometimes look the other way if they kind of said, well, something's really not right, but we don't know what it is, but we're not going to ask about it, because he paid them millions and millions of dollars in fees to them. So let's get back to assets. If you own a residential property, it's not like a stock where this today at 9 o'clock, stock opens in the New York Stock Exchange, let's say 9:30 in the morning, New York time. Well, by 2 o'clock, you could be wiped out, because that stock could, whether it's a fraud, they underreport, maybe they don't include some material facts in their reporting for a variety of reasons. Sometimes it's criminal. Sometimes it's just a mistake. So with a stock or anything like that, or some risk, venture capital is a risk. When people go to venture capitalists in Silicon Valley, they're like, it's like a pro forma. They're saying, I'm going to do this. I need your funding to do this later. It's, they have the make, fake it till you make it is common in Silicon Valley, and some people have actually, the guy who created, Google, and not Google, Oracle, basically was one of those guys. He took some shortcuts, but he was doing software. Whereas Theranos, Elizabeth Holmes, and Sunny Balwani were very much, you can't fake it till you make it in medical, and people's lives and their health is at stake. So, you've got to understand that is, there's a lot of issues there with, those are non-tangible assets. Those are pro formas. Those are, hey, this might happen, or we're working on this and we need some seed money. And then we have a second round, another round, and then finally they take it public. Theranos didn't want to take anything public. They didn't want to bring in other people. Who knows? Did it start out maybe the first 3, 4, 5 years? It was, then they lost control when they couldn't get the product to get the Edison to work the right way, and the technology. Because I don't see where you can actually take one drop of blood and get 100 tests out of it, let alone even like 3 or 4 tests. There were some that could do, I think they did a syphilis, or I forget which one it was. They got all excited about it because they could do one test, and they weren't able to actually do. They flew to Switzerland to show to Novartis, and they could not get the test to work there, and for whatever reason. So they actually had the results. They didn't run them. They just took them, put them in the machine, and then they had them run the test in Palo Alto and send out the same test strip, the same results that they'd gotten the other day when they had tested it before they went out there, and it was fraud. And Novartis eventually never gave them a penny, but Safeway did, and Walgreens did, and a number of other people. I mean, I think it was like one time the valuation was like $8 billion, but that was all conjecture, promise, fake it till you make it. Same with a variety of other entities and companies that, maybe they're, in computers, you can get away with that if you do that in IT, if you're working on some kind of coding technology, or, something that's out there that you can create, that you can actually get investors to back it. And you can get a second round or a third round as long as you're showing results and you're working on it. And that happens a lot. It happens sometimes, at Apple, it happens, and Microsoft, every company has some issues when they're trying to do that. That's why it's seed money. You get that first round seed money, you get their second round, Then you go to the third round, you do the IPO. By the time you have the IPO, you better have it right, because you can go a lot, when you go to the stock market, there's a lot of things that can go wrong if you're not legit, or if you're, having issues. And like you look at Enron was actually a profitable company that did real things until it was developed by Ken Lay into a, and the different people, the officers of the company that took it to a lot of fraud. They created whole divisions. Andy Festa, the CFO, created hundreds of entities, LLCs, where they basically hid passed off the debts and the bad deals, and that made the company look healthy. This was a company that apparently on paper had zero debt. It had a lot of debt. It was all off the books. It was all in these other entities. And so they created them, and Ken Lay and Jeff Skilling, Andy Fastow, a few other executives, basically turned it into, it was basically everything was in air. And they did this stuff because their accounting system, mark to market, where you could do a proposal and say, hey, we're going to generate $100 million off this deal. They would pay the people their bonuses then, and not actually have it, if that way, let's say I'm going to make $200 million in the next 5 years, and I put that on paper, my company pays me $4 million based on those projections. Those are projections. So they're paying you. What happens when it doesn't work out? What happens when it fails? They paid you the money. So that was ripe with Enron. Enron was somewhere around $50 to $60 billion when it went down. Same with, obviously FTX on the crypto. Crypto is fascinating, but it's very, the people that are doing these scams, and even the people doing legitimate crypto, they're MIT, Harvard, Stanford business, Oxford business. These are some pretty high and, educated and intelligent people. Most of them are like, the people you would consider geeks. It'd be hard to go look at blockchain and other things and know how to do it. Coding is, goes up to another level. There's different things, because a lot of people that are in computers and IT tend to be introverts and not very sociable kind of people. So just, not going to say anything bad about that, but that's just generally how they are. But if you get into the tangible assets, I think it's the more charismatic extroverts are into real estate and metals and minerals, because you have to go out there and sell yourself, and you have to, to get investors, to get partners, to get lenders. You have to, go out there and find the properties that are going to generate ROI, whether you're flipping them or you're renting them, developing them, or, anything that's real estate. So the why is, why do I want a physical, tangible asset? I want to own something. I want to be able to drive up to it. I want to have my name in the title of it. I want to be able to have it in my safe or my vault or my, bank account to a certain degree. Obviously, there's people that don't like banks these days. Banks are here for a while. They're not going to go anywhere. I mean, some may fold up, some may, get bigger, but banks are generally going to be here. I want to own things. I want you to own things. I want you to own real estate. I want you to be able to invest in metals and minerals, oil and gas, things, lumber, timber, physical things you can actually buy, or you can actually own a piece of. You get the paper that says you own it, the title, whatever it is, the contract, you own it. It's yours. And you can work on it. If you're going to be active, you are managing that asset, and you're basically generating the income and the revenue. If you're passive, you invest in it, but you're still going to have your returns and your percentages and your waterfall. And you want to, obviously you're going to have to put some faith into the operators, but it's still something you own. You own, if you put $100,000 into $1 million contract, you still own 10% of that, whatever that arrangement is, because they can obviously extrapolate investment dollars. But I want to own things, and I want you to own things. So the next probably 999 videos are going to be, a lot of them are going to be teasers for the general public. This is the long form teaser. There's going to be teasers, short form, and long form videos, and deep dives. And the deep dives are going to go into some very technical underwriter notes and things that most people don't get. You'll be able to get those if you're interested in them. They're very dry subjects. We're not going to do a whole lot of them. We're going to do maybe a couple just for each of the asset classes we're going to talk about. Just, these are the notes, these are the details. You get into metals and minerals, you're talking 43-101s. If you're talking real estate, we'll look at HUD-1s and some other documents, but we want to go through all the asset classes and teach you about it, to how to build income and cash flow and wealth and so we're going to be doing that over the next year between now and December 31st. As we do this, we will be going to be building up for the virtual platform that's going to go into this in depth. I'm going to bring a variety of experts on, people who are doing it, whether they're securities attorneys, tax attorneys, class segregation people, rehabs people. We want to bring in a lot of people that are knowledgeable. We're not going to call them gurus, mentors, coaches, or experts. We're going to call them, facilitators and people they're doing it. They're actively doing it, and they know they can give you kind of advice, and not legal advice. Legal information is not legal advice. Just, there's a disclaimer there. I want you to participate, and as our masterclass, after the masterclass, obviously we're doing mostly real estate, but we're going to be transitioning and building that up for all physical assets as well as real estate. People can just take the real estate portion, or you can actually go into other things and how to acquire a lot of gold, how to work, do accounts at the Mint or the Royal Mint, or the Mint in South Africa, obviously Switzerland, Australia. Who are the best mints to work with, because you can buy directly from the mints if you buy in volume. So we'll show you how to get those accounts, but mostly real estate right now. And it's just fascinating watching a lot of the information out there. And we call it the white noise. The white noise is just all the information combined, both bad and good. A lot of it is bad because you got a lot of people that just jump in, they get their first, second, or third deal, and they're suddenly selling courses or mentorship, and a lot of bad information that they may have received. It may not even be their fault. You got a lot of wholesalers out there. Not all wholesalers are bad. Probably only 10% of them are bad, but you got like 90% of them kind of sometimes get into the white noise of wholesaling, as well as there's so much bad information out there. So one of the things, like I said, why I want physical, tangible assets, I'm just going to get back to it. I want to own things. I want to possess things. I am materialistic. I am a capitalist. I make no apologies. I'm not, no matter what, I'm never going to make an apology for wanting to own things and build, have income, cash flow, and wealth myself to be able to pass on to people, to my family and my friends. And so that is why I own tangible assets. And that's why I want you to own tangible assets. It's incredible when you own things, because when push comes to shove, the people in the crypto are not going to be able to produce. If there's no electricity, or it's all of a sudden there's a conflict or civil war, or there's a disaster, what happens when you can't access your crypto wallet because it's electronic? What do you do? How are you going to eat? You know what? I can eat because I can sell things, trade things. I can rent, let people live in my property, things like that. So that's why I want to own things, because even, the best case scenario, you're building income, cash flow, and wealth. Worst case scenario, there's a disaster, human or natural, and you have the resources to survive. You can own water, you can own land, you can own farmland, you can own crops. Those are tangible assets. You can own those as well. It's just like oil and gas, minerals, metals, timber. You can own all that, all natural resources. You can own natural resources. What you cannot own, you can own intellectual resources, but it's hard to generate income and cash flow off of them. But you can't own, you own the stock on paper, but it can be wiped out relatively easy. And 99% of the people that own stocks or bonds or invest in things like on paper through, like, they don't understand it. They wouldn't know how market making works. Nobody knows what a market maker is. Nobody knows how an IPO is, or what a Series 77, a Series 82, or a Series 63, what they do. Everybody knows Series 6 and 7 deal with stock, but those other higher ones deal with other forms of securities and financial, the world and all that wealth. And so with physical and tangible assets, you also don't need, you don't need to be a licensed mortgage broker to be a private money broker. And there's a couple between 43 and 46 states, you're good. California, you need to be brick and mortar. Arizona, you need to be brick and mortar. Nevada, you need to be brick and mortar. There's like two other states. I think it's South Dakota and South Carolina and Idaho. So I think there are 6 states you have to be brick and mortar or have, a license in. Other than that, you can operate as a private money broker in every other state. There's no legal requirement. You can actually have a mortgage broker license and be a private money broker and work both sides of real estate. Because as a private money broker, or if you're on this side, private lenders, private money lenders, they can't lend a penny on an owner occupied property. So they just can't do it. It's part of the Frank Dodd Act. So you guys can't, so it's a good thing. There's Glass-Steagall and there's Frank Dodd, Todd Frank, Senator Chris Dodd, and Representative Barney Frank. There were, I believe they were the chairman of both the Senate and House financial committees, and they dealt with the 2008 crash, and they did TARP, the Toxic Asset Relief Program that was created by the Federal Reserve and the FDIC and the SEC, back then. So they're doing with like stocks with Lehman Brothers. I mean, Lehman Brothers and AIG almost brought the economy down 100%. I mean, they literally almost crashed. Lehman Brothers went out of business, 100 years in business. AIG is still in business. Don't know why, don't know how. They're involved with some other really corrupt and fucked up shit, just to put it plainly. So what we want to do, guys, as much as, stocks and all that and your pensions, you want to own things. You want to own physical, tangible assets. And the next 1,000 or 999 videos are going to go through that and explain that from, you're going to go from 0 to 100. And you're going to learn about all the different real estate classes, how to buy them, how to acquire them, how to manage them, how to rehab them. You're going to learn about physical assets like oil and gas, in-ground assets. You're going to learn about energy assets, in-ground energy assets. You're going to learn about, metals and minerals, and it's going to be really an incredible world. And we're going to provide the resources for you to actually own things. So with that, guys, I appreciate everybody's time. This is the first one. We got 999 to go. I will see you tomorrow on number 2, and we're going to start on Thursday. Tomorrow will be one more video like this. On Thursday, we're going to start with doing. We're going to start with some basically how to get into real estate. It's going to be like a 0 level course, not even a 101. Where you need to start with to actually begin in real estate. And on Thursday, Friday, Saturday, and Sunday, we're going to start doing single family flips and single family rentals. And then we'll do a few videos there. We'll jump over to multifamily syndication, self-storage, senior housing, mobile home parks, short-term rentals, commercial real estate, things like that. And we'll go through the different asset classes, and then we'll build on those. So we'll build on those asset classes, which we'll keep building on single family. We'll keep building. And so every couple of weeks, you're going to probably go and see 4 or 5 more videos, but then, we'll do multifamily maybe a couple days. And so that's kind of the schedule. Keep in mind, guys, we still have the Masterclass and Investors Download Center. March 22nd is our event. You can sign up on Google free. March 27th is AI. You have to be in our Masterclass or Investor Download Center to participate live. So it's $397 for the Masterclass and $100 right now through March 30th for Investor Download Center. After that, it goes to $1,500 and $599 respectively. So you want to get in now. You're going to get 999, 5 to 7 minute videos, but it's not going to be enough to actually, because you're not going to get the lenders, you're not going to get the investors, the fund managers, you're not going to get all the documents and paperwork. You may see them, I'm going to talk about them. You're not going to get them. But doing 1,000 videos, you're still going to be able to get a pretty good education. What I would do, though, is I would seriously join Masterclass. It's probably the best $397 you'll ever spend if you want to build wealth and own things. With that, guys, I'm going to sign out. Thank you. Stay tuned tomorrow. Same bat time, same bat channel. Talk to you later.